Here are my top 5 factors that could impact markets in 2025. At number 5, it's inflation. Will prices keep rising? High inflation has been one of the hot topics of 2024 and 2023, with rising prices affecting us all. And we predict it will continue to have a major impact in 2025. The rising price of materials and labor can significantly impact the bottom line of any business and challenge its profitability. That is why we focus on identifying quality companies that have strong pricing power and can protect their margins effectively. At 4, it is interest rates. To cut or not to cut? Lower interest rates are typically good news for equity markets, and many central banks cut interest rates in the second half of 2024. Typically, this is particularly supportive for quality growth stocks, which are the types of companies in our portfolio, so I would welcome more cuts in 2025. However, we could expect further volatility as the market expectations on rate cuts change, and the reaction to inflation data throughout the year will be key. This is something we shall definitely be keeping a close eye on. At number 3, it's finding growth in rapidly changing environments. It is fair to say we are in a low growth environment. So how do we find the pockets of growth in order to generate positive returns for our shareholders? In reality, there are many bright spots and many sectors of the global economy that are thriving. At a high level, we believe that artificial intelligence, the energy transition, and aging population are 3 areas that offer some exciting long-term prospects, and our portfolio has many companies operating in those areas. But with many investors focusing on those sectors, it is essential to really understand which companies can actually monetize the opportunities to drive an increase in their competitive position, their earnings, and share prices. So having a strict valuation discipline and a focus on fundamental research is critical to seeing through the hype and the froth. And we have a consistent approach to both. The second most important factor is China and its potential to recover. China is the world's second largest economy. It is a massive exporter of manufactured goods and also one of the largest consumers of products and services, particularly some of the luxury brands we own in the portfolio. China's government has recently taken some effective steps to boost growth, and the economy is showing the early signs of the benefits from that, and we hope this will continue. Geopolitically, concerns linger about their relationship with Taiwan and the impact that could have on the global supply of microchips that is based there. This issue has sparked the building of chip manufacturing capability in new sites around the world in an effort to de-risk. And of course, China's relationship with the US and President Donald Trump is critical. The potential risk of the introduction of tariffs and the impact on global trade will be critically important for markets in 2025. And topping the chart at number 1 is President Donald Trump. The re-election of Donald Trump as US President could be the most significant event for markets in 2025. He has promised many things on the campaign trail, some of which may be supportive to global markets, and others that could be negative and introduce downside risks. Trump's administration may introduce tariffs that could increase inflationary pressures, but could also apply tax cuts that may help US companies. That said, both tax cuts and trade tensions could fuel a more inflationary trend, which could impact or slow down the US Federal Reserve's rate-cutting runway, and other central banks could then follow suit. Either way, Trump's policies will have a significant influence on the US economy, directly or indirectly, impacting inflation, monetary policies, and taxation. And as the world's largest economy, that's likely to have a ripple effect around the world. What should investors take away from this? Global equity markets are continually affected and impacted by events, both negative and positive. As long-term investors, thinking 5 to 10 years ahead, we believe that equity markets offer the best opportunity for investors to grow their wealth over the long term. And we believe our approach, which favors quality growth companies with higher margins, solid balance sheets, low disruption risks, and exposure to structural growth streams, is an attractive proposition.